Hey guys, JC Parets here of StockCharts.com, and I brought some of my favorite charts, and I just want to share them with you. We're going to talk about some of the things that stood out on last night's call. We do a monthly conference call for our clients where we go over everything, all the major trends in stocks, in bonds, commodities, currencies, within the stock market, different sectors and individual equities as well. So a few things that I kind of just want to run through that stood out from last night's call. Hopefully you guys find some value in that and ping me if you have any questions at all. And the one thing that, for me, I think that just really stands out is the fact that, we've been saying it again and again and again. It's classic year two behavior, messy markets. We saw it off the lows, off the 09 lows, great first year, and then just a messy market after that. Same thing in 04, after a monster year in 03, off that low. What happened in year two? Chop, chop, chop. Same thing in 83 off the 82 low, and same thing in 76 after that monster year in 75, right? So anything that's not like this would actually be very unusual. Right, so this is very classic. Look at micro caps, look at small caps, just a hot mess, just sideways hot mess. And this comes as the Dow Jones Industrial Average hits our upside objectives. So for now, if the Dow's below 35,500, below 34,600 or so, those highs, I think messy for longer is probably best. We'll let the market tell us when it's ready to move on. I don't think it's there yet. Same thing with transportation stocks. That's where the dead bodies are buried up here, right? These are weekly closing, new weekly closing lows after going up 14 consecutive weeks. The Dow Jones Transportation Average is down, I think, 5 out of the last 6. So taking a well-deserved break at a logical area, right? So chop, chop, chop. Let's see what happens next. But I think it's going to take some time at the very least. Then here's a longer term look at the transport, same exact thing, right? From the key extension off the 07 highs, boom, there's your extension. And then of course the extension off the 18 highs, boom, there's your extension. So a lot of reason for digestion for transports here. Doesn't mean that it's going to be the end of the world, but I think it's certainly a perfectly logical place to see this sort of behavior. And I would expect that to continue in those areas. Same thing with financials. Right, we ran into that level off the 2018 highs, and then sure enough, we corrected from there. How long is it going to take? I don't know. That's where all the dead bodies are buried, all up there. Any strength into that area is likely to be met with supply, quite a bit of it in my experience. So neutral for longer for sure here. Look at healthcare. I do like how it's consolidating up here in a much more healthy fashion than some of the other sector counterparts. We haven't gotten a breakout and everything is suspect as long as we're below 125, and we're basically right there. But that's the key level. That's the extension level from the COVID crash, right? So there's that level. So if we're below 125, there's nothing to do. Let the market prove that the last couple of months of digestion is over and we can go higher. Or if this is just more of like a top and then we're going to correct to the downside. It could be either one of those. My suspicion is it's going to be messy for longer versus a breakout. But hey, if it breaks out, we buy it. I got no problem with that. I just don't think that is what's going to happen, but we'll let the market dictate our actions. Same thing with energy, running into a logical level, just continues to struggle near these levels. These are the 2016 lows, which were also the 2019 lows. Then we collapsed last year, right? That was all she wrote. Crude oil trades negative, the whole thing, right? Now here we are back to the scene of the crime. So if energy is going to digest gains and be a mess, again, this would be a logical place for that to occur. And when you look short term, it certainly is messy. But with crude oil continuing to make new highs, I think that it's further information that, number one, energy is probably a place we should look. Number two, think about just how strong oil has been with copper and lumber getting freaking destroyed, right? So there's some kind of strength there that is hard to ignore. So I think that's important, but nevertheless, the big lesson here, once again, is to not overthink the intermarket analysis and just trade what's in front of you. Had you not looked at any other chart in the entire world and just bought the breakout in oil above 66, that trade has worked out very, very well. So again, And I used to do this all the time back in the day, and I would overthink the intermarket analysis. It's like, all right, well, if the dollar's doing this, then oil's going to do that. Emerging markets are going to do this. Let's short Peru. Like what? It's like if you like oil, just buy oil. That's really how I see it. I learned that lesson the hard way. I remember I was having a good conversation with a great technician, Chris Verone, and he was talking about how he was bullish healthcare, and I was like, all right, but at the time, like China was rolling over, and we were shorting those stocks, and I'm like, yeah, but what about China? And then Chris is like, you see, if you don't want to buy China, don't buy China. But what does that have to do with healthcare in the U.S.? And I'm like, and then healthcare went on to like break out and do very well. So again, I think that was like 10 years ago having that conversation, and it stuck with me, right? Because I used to overthink the intermarket analysis way too much. All right, so that's my lesson there. We always try to have at least one lesson. So if my charts suck, at least you get like one good tidbit that you could take home. And the tidbit is don't overthink the intermarket. Don't overthink the intermarket analysis. All right. Now, with that being said, with respects to risk and risk aversion, the bond market's the biggest and strongest market in the world. It's the big boy sandbox. It's where if there's real flight to safety, if there is a real struggle out there in the market, you're going to see it in the bond market. And with new highs in the S&P 500, we just haven't seen that out of bonds. Credit spreads not so much blowing out, but widening somewhat, which is not consistent with higher stock prices. It's consistent with an environment that stocks are under pressure, and for the most part, I think the average Nasdaq stock is down 10% off its highs. The average S&P stock is off 8.7% off its highs. The Russell 2000 has done nothing for 4 months. Microcaps nothing for 4 months. Nasdaq's been super choppy. So I think just in general, we've been in on a correction, and it's not anything new. I think when you're only looking at the S&P 500 making new highs, and you're not looking at what's going on in the internals inside the market, I don't think you're getting the full picture. And the full picture is we've been in a correction since I'd argue February the 9th, February the 8th, when the new highs in the Nasdaq peak. February the 8th, probably a good anchoring date. And now that we come to mention it, we're going to start anchoring from that date because I think that was good. But even since then, we've seen rotation, most certainly, into financials and energy and industrials, and then out of financials and energy, industrials, materials got hit, all of them. So we came in, this is a couple of weeks old chart, Aussie yen and the S&P 500 moving tick for tick together, right? Tick for tick. It's like whichever way this sucker resolves, up or down, it's going to probably tell us a lot about the blue line, right? And then what happened? We broke down, right? And the blue line's vulnerable. So that's how I see that. Can we recover, and can this just be part of that messy market, that 4-month consolidation, the 4-month, cyclical bear market or correction or whatever you want to call it? Whatever we've seen since February, we also saw it in Aussie yen. And maybe we're just still in this range. Maybe this is not a diagonal uptrend line. Maybe this is more of like a rectangle. And then we ultimately recover, repair this, and then break out. That's certainly possible, but I need to see it. All right, so here's the S&P 500 on its own. What's interesting about the S&P is that it's consolidating above its extension level versus then below. In many cases, you're seeing these consolidations taking place below their extension levels. In this case, it's doing it above. So as long as S&P is above 4,100, like I don't really see any cause for concern. Not crazy cause for concern, unless that happens. I think it can happen. I think we have to be open-minded to it, but it hasn't happened. But if we're making lower lows, which to be clear, we are not making lower lows, but if we start making lower lows and we're below these former lows, yeah, that's a big problem, especially with momentum diverging the way it has. Right, so we're seeing lower highs in the S&P, in higher highs in the S&P, and just momentum continuing to roll over. So we're seeing a lot of that. Now, does that mean that the market needs to crash? No, but it's certainly not indicative of a market that's should be strong moving forward. Maybe this resolves over time and then ultimately breaks out and stocks break out. That can happen. But just the whole big picture of this, if we start losing 4,100. We start breaking below those lows from May, right? The May lows right around there. If we start breaking below that, it's a big problem. By the way, this is not, sorry guys. So if you are interested in the slides, just email info@allstarcharts. Make sure to use the password hottest of messes. So the password is going to be hottest of messes. Sorry, guys, I'm just deleting an old one. So hottest of messes. If you want these slides, hottest of messes is the deck for this. And you know, people keep telling me, the journalists keep telling me inflation's here, but the bond market sure has a funny way of pricing in inflation by breaking out of these bases. All right, I'll tell you that much. That sure is a funny way for the market to price in inflation. To me, it's quite obvious that it's the exact opposite of inflation. If bonds are breaking out and rates are breaking down, hello. So our bond long positions are working out, obviously, and the levels remain the same. 114 on the IEF. To me, that's the cleanest one of all the bond charts. That's the cleanest one. Not, again, if this is working, a lot of the other bond proxies are going to probably be working as well. But just from a risk management standpoint, which to me is the most important, those former highs, right? So 114 on the IEF. If we're above that, we want to stay long. Look at the breakout in TLT. That'll probably do well in that environment as well. And then this is the big one, right? So how bad can things get? When you tell me, JC, what's your, right now, fine. I've been a ton of cash for a while and have been thrilled about it. As a matter of fact, I don't hear anybody complaining that they're in too much cash. I just hear people getting chopped up. A lot of people getting chopped up. So what's it going to take for things to get worse? That's really my big question, right? What's going to go? Maybe this is a sideways range that resolves higher, or is this more of a top and things are about to get worse? I think rates are a big one. 1.4 on that. That's the level. If we're down here and just a kickback and a retest of that 1.4 level, and we hold the lows from the past week, I think that would be very constructive. I think that would be bad for our bond trade. We'll probably get stopped out of that trade. That can certainly happen. A breakdown below 1.4, below the lows from last week. If we lose those lows and we start falling apart, which I think is certainly in the cards. I don't know for sure what's going to happen, obviously, but I think it's certainly in the cards. And if we lose 1.4 and rates start falling apart, I can't imagine that that's happening in an environment that stocks are doing well. That's probably happening in an environment that bonds are doing well, right? These bond trades are probably doing very well for us, right? And stocks are not, obviously. Right? Maybe not obviously, but yeah. And then again, how bad could things get? Here's the regional banks, right? So those former highs, that's the one for me. So these former highs from 2018, which have been the recent lows over the last several months. I mean, if you want to talk about a chart, look at regional banks. I mean, those are the highs. And then look at that. This market, it basically just defines how this market environment has been over the last 4 months. One of the hottest of messes. Hot mess. And that's fine. It's just the market environment that we're in, but we're above those highs from 2018, at least for now. So if we lose those, that's a big problem, and it will most likely be happening in an environment that rates have lost 1.4. That's probably happening at the exact same time. And then if you want to take that thought process one step further, here we're looking at regional banks relative to the rest of the market. Whoops. Here's regional banks relative to the rest of the market. Those former lows from 2011, interest rates bottomed, right? These things look awfully similar. I think that these are similar trades here, bonds and regionals inversely to one another. And then look at European banks at 20. So, to me, the most important chart and one of the most important charts in the world right now is the KRE. We're going to go over arguably 3 of the most important charts in the world. One of them is KRE. If we're not above the 2018 highs, that's a big problem for stocks. The TNX, which is the 10-year yield, if that's the 1.4. And then this one right here, European banks at 20. European banks are not above 20. That's a big problem, right? And again, I think all of those are related, I believe. So if European banks are not above 20, and currently they are not, to be clear, after that gap and go on Friday, that has not really been able to recover. That's got to be the most bearish chart in the market right now. Now that I'm saying it out loud, this is the most bearish chart in the market right now. European banks are below 20. It's hard for me to be aggressively bullish of equities. That's how I see that. And then what's it going to take for things to get worse? Well, we need to see an expansion in new lows in longer term time horizons, right? We saw a spike in the 21-day lows in the S&P 500. Not a crazy spike, but a little how you doing there? You know what I'm saying? But we're not getting it in the 63-day lows yet, right? That would be next, right? So if you ask me, JC, what would be next for things to get worse? you'll see an expansion in the 63-day low list, and rates falling below 1.4. And then some of you are wondering, well, JC, why 21 and 63? And just to be clear, 21 days is approximately 1 month of trading, and 63 days is approximately 3 months or 1 quarter. We're not seeing it in the large caps, mid caps, or small caps. We're just not seeing in the 63-day low lists popping up. You know, a little bit more on the small caps, but really nothing to write home about. You'll see massive spikes in these if things are getting worse internally. Same thing internationally. We did see a spike on the 21-day low list, but again, nothing. Just a ghost town on the 63-day low list in terms of countries around the world making new quarterly lows. We're just not seeing that, right? So that would be next. For now, this is just a messy market at the same levels that peaked 14 years ago. And it's a logical place for this to happen. So we're watching that take place. Same thing in the ACWI All Country World Index, right? Where is this happening? It's happening where it happened back in 08. So this is a logical place, bearish momentum divergence. So it leaves this vulnerable. ACWX is the ticker symbol. And it doesn't look good. It doesn't look good at all with that bearish momentum divergence. Things went from getting progressively less good, right? Since February, things have gotten less good, but they weren't getting worse, right? There's a difference. There's being less good, and then there is getting worse. In other words, more new lows, you know, more sectors making new lows. We're starting to see slight expansions in those. So it's not just things are getting less good. Now things are getting a little bit worse. Now, in order for them to get a lot worse, they first have to get a little bit worse. And that's what we're seeing now, a little bit worse. Meanwhile, micro caps and small caps, if this doesn't tell you the story of what's going on this year, you know, I think you look at regional banks, which is kind of like a small cap story. They have much more exposure there in the small cap space. So I can imagine why they would look more similar than to other indexes. But needless to say, just a choppy mess. Just choppy mess, which is very characteristic of year 2, right? So shouldn't this be expected? We've seen this before. It's deja vu all over again, right? We've seen this before. So, all right. So let's talk about some of the things that are bucking the trend. We're looking at some of the growth areas. We're looking at the equal weight Nasdaq. This is QQEW, and if that breaks out, it's hard to be bearish, right? So if you want to talk about things getting a little bit worse versus things getting less good, in this case, this would be I would think a very good thing if we're able to break out. Now, to be clear, we have not. But a breakout in this index, equally weighted Nasdaq 100, I think would be really bullish for stocks. I need to see it. Haven't seen it. I need to see it. But if this isn't the chart of the quarter right now, I don't know what is. So you're looking at 110 on this. So if you're above 110 on the QQEW, I think that's really, really impressive. I think that's got to be bullish for stocks. As of this recording, we are not. But that's on my radar. To me, there's a higher probability outcome that we sell off. I guess we'll see. But listen, I'll let the market dictate my actions. I really don't care either way. You know, just to be clear, some of you know that about me, some of you don't. It doesn't matter to me. The stock market can get cut in half from here. It could double. I don't care if gold goes to 10,000 or if it goes to 0, Bitcoin to the moon or to 0. It doesn't matter to me. For me, I'm just trying to be on the right side of the trend. Just to be clear, for those of you who are sort of unaware of how we approach markets, look at Apple. You know, just a big consolidation here, right? Just it's the hottest of messes. Hot mess. Jeez Louise. Look at this thing. You think of all the people getting chopped up in this mess. Ugh, you can have it, right? So anyway, the resolution out of this, I think, is my final point. The resolution out of this is going to be really telling. Same thing with this, right? So a couple of important charts here to finish off. And now let's look at something interesting. What I like about small caps is the lack of correlation with the, you know, with the markets. Or I should say less correlation with the markets, because the thing with small caps is that, you know, in the big caps, you're going to get much more exposure to the macro elements because it's so massive and it's so intertwined in other trades that these institutions have on. But in the small cap space, you know, because it's smaller, these institutions can build big positions and they're going to knock it around more so than the macro, particularly relative to some of the more mega cap counterparts, right? So there are opportunities in small caps. You'll find stocks doing really well in bad environments, and you'll find stocks doing really poorly in good environments. So if you're looking to go fishing for, less correlated stuff, I think small caps are where to do it. So here we're looking at what we call the minor leaguers. So these are the small cap stocks, specifically between $1 and $2 billion in market cap, and we are sorting by relative strength. So while the small caps have done this, chop, 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 we want to see the ones that are holding up the best, so that if and when this overhead supply stops, is absorbed by demand, and we can then move on. The ones that are going to move on the hardest are the ones that are already showing relative strength, and that's what this scan is. And we have some scans that are specifically focused on certain industry groups. This one, we open it up to anybody, so you'll find anything from packaging companies to utilities or REITs or banks or, specialty retailers, anything and everything, oil and gas. So that's something I really like about this. It's also long and short. In this particular case, we're looking for relative strength, because while the Russell 2000 has just been a hot mess, the ones that are acting better are the ones that are getting our attention. So that's how we look at small caps, and we've got a whole list. If you're interested in receiving that, feel free to reach out to me. You can ask for the slides at info@allstarcharts.com, password hottest of messes. If you're interested in those minor leaguers, make sure to ping Peter to send those to you as well. But here you can see the list, and then we go and hand select the best opportunities based on the most opportunistic risk reward, where the risk reward is skewed in our favor the most. All right, and then finally, I just want to talk about one last trade. And to be clear, I'm not like Mr. Diamond Hands or Hodler. I'm not, buy the dip guy. Like, I don't abide by any of that stuff. I just like being in opportunities where the risk is well defined and the potential reward is exponentially greater than that potential risk. That's all I'm really interested in. And I'm much more interested in opportunities where that risk is very well defined. That's me. Long, short, commodity, stock, tech, utilities, doesn't matter. It's just letters and math. That's how I look at that. So that's my rant on that. All right. So what happened in Bitcoin yesterday? So yesterday, we have been talking about that 30,000 level. It looks like they were going to retest 30,000 on the Bitcoin. It looked most likely, it just kind of looked toppy. Sure enough, we got there last month. I've been consolidating, and it looked like we were going to roll over again. Sure enough, we did. And then quickly recovered back above those former lows. Like, I think that, right? So we broke down to new lows, quickly recovered back above these former lows. Meanwhile, momentum put in a nice bullish divergence, or a potential bullish divergence, and then this sets up the opportunity. I don't know what Bitcoin's going to do. What I do know, and quite frankly, the only thing I know, is that if we're above those former lows from May, I want to be long Bitcoin. And if we're not above those former lows from May, I do not want to be long Bitcoin. How high can it go? I think it can head back towards 47,000, right around this area right here. Maybe. That's where I'm going to be taking profits. Can it go higher than that? Absolutely. I don't know how high it can go. The only thing I do know, and the only thing that I can control, is where I own it. And I am only going to own it if we're above those former lows. And why 30,000? Well, look at the highs in 2017 down to the lows. The 161.8% extension of that takes us to 30,000. Then if you take the recovery high, right, down to those lows, the 71% crash in between the breakout, that also takes us to 30,000. So there were a lot of reasons why this was our target. This chart comes from December, but there were a lot of reasons why that 30,000 was our target. And sure enough, it did. We exceeded it, blah, blah, blah. You know the history. So anyway, that 30,000, just because it was important then, doesn't mean it's now no longer important. I would argue it's even more important because the market has recognized it in the past. So I think it's even more important. And then sure enough, in May, it confirmed that yes, in fact, that 30,000 was still relevant. And then sure enough, yesterday reiterated that point. So here, I mean, I'm not Mr. Elliott Wave guy. I have formal training on the subject. For me, it's hard to ignore the clean waves, 1, 2, 3, 4, 5, right? It's hard for me to ignore that. It looks pretty clean to me, which would be indicative of a final puke low. You know, if you're not into counting waves, you don't have to. Just think about philosophically, the fifth wave is that when finally people, you know, are finally like, oh my God, yep, you know, it's finally going to go to 20,000. And the reason I think that that was the case, you know, and this got skewed once Bitcoin bounced, but at one point, this was 80% of the people that answered were talking about Bitcoin going to 20,000 first. So 80% bears is what I was seeing. So sentiment was very indicative of that fifth wave, very characteristic of that fifth wave down. And it reminds me of the S&P 500, 07, 09, right? 1, 2, here's your 3, 4, 5, just very clean 5 waves. Same thing as Bitcoin. That's how I see this potential double bottom, right? So my favorite double bottoms are when we undercut the prior lows, quickly recover, and then rip. These are my favorite double bottoms, right? And then when you add a bullish momentum divergence, forget it. You know, I tweeted this out. We talked about it in this video. You know, this is my favorite double bottom, when we undercut those lows and then we squeeze higher. Those are better, way better. From failed moves come fast moves in the opposite direction. We call them whipsaws. Don't be scared of them, embrace them. And then, by the way, just to be clear, on a final note of risk management, if that is not a 5-wave count in Bitcoin, you better be careful, because if this tornado of a bottoming process is not that, if this is not a bullish momentum divergence, if these are not 5 waves down, if this is not a double bottom, and it's something like this that looks exactly the same, look, 1, 2, 3, 4, 5, double bottom, bullish momentum divergence. This is coal back in 2011, 2014. And then what happened? It broke down and fell another 70% and ultimately got delisted. Rest in peace, no longer with us. But I just want to reiterate how important it is to recognize, if it's not what you think it is, particularly in these instances, it could be disaster, which means, you know, Bitcoin down towards like 3,000-4,000 potentially. Who knows? I have no idea. And I'm not saying Bitcoin is going to go to 3,000, 4,000, 5,000. I'm not saying that at all. I have no idea what Bitcoin is going to do, just to be clear. But what I am saying is that if Bitcoin is above 30,000, we want to be long. That's it. And if it's not above 30,000, we do not want to be long. And that's really what it's about. How low can it go if it breaks? I don't know. Because it's not my problem at that point. Now it's somebody else's problem, right? And then when Bitcoin gets to 46,000 and I'm going to sell it, it's no longer going to be my problem. Now it's somebody else's problem. I'm going to observe, you know, and then see how it reacts to those levels. My suspicion is it's going to run into some trouble. I guess we'll see. The market doesn't have to care what JC thinks. But I think that there'll be some trouble there, and then we'll see what happens. But listen, fire over the questions. Let me just put it up here one last time before I hop. Fire any questions you got to info@allstarcharts.com. If you're interested in the slides, just make sure to use the password hottest of messes to make sure that you get this particular slide deck. I give, you know, a few presentations a week around the world, so just make sure you get the right deck. This one is for StockCharts, hottest of messes, info@allstarcharts.com. And there you have it, folks. So as always, I appreciate the time. As Jay-Z once said, you could be anywhere in the world, but you're here with me. So I appreciate that.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.